In this example video, we're going to look at review exercise 4-6 and put together the property, plant, and equipment section of the balance sheet. So the property, plant, and equipment section is where we list any fixed assets that we have, so things like land, equipment, buildings, machinery, and any associated accumulated depreciation on those assets. So they tell us that our corporation has the following assets at year end. So they have a patent that's net. When it means that it's net, it means that it's showing at the value net of that amortization expense that has been subtracted away. We have land, buildings, accumulated depreciation on the building, an investment in held to maturity bonds. We also have equipment and accumulated depreciation on our equipment. So looking at the information provided to us, we are not going to include those patents because although they are an asset to us, they're an intangible asset. So they do not belong in the property, plant, and equipment section. They'd actually be in the intangible asset section of our balance sheet. Investments in held to maturity bonds also are assets. However, that would be in our long-term investment section. We plan to hold on to those investments until they mature, however many years that might be. So it doesn't fit into our fixed asset piece. Anytime that you're putting together your property, plant, and equipment section, if a company owns land, we always list that first because it's the only fixed asset that is not, in fact, depreciated. So in this case, they do have land, so we're going to list that item first in our property, plant, and equipment section. They then have a building. So our building cost us $175,000. Remember, GAAP requires us to record our assets at what we paid to acquire them. So that building account is capturing how much we in fact paid for that building, but then we have to subtract away our accumulated depreciation on that building. So we believe that our building has come down in value by a total of $57,500 over the years because we're using that building to help run and operate our business. And again, depreciation is a way for us to slowly kind of eat away at that initial cost value. The whole point of us buying that building was to help us run and operate our business. And if by doing that, it's eating away at the value, that it should be recorded as that expense. And we keep accumulating it into that contra asset account of accumulated depreciation. And the difference between the initial price paid and the amount of accumulated depreciation is known as the asset's book value, how much value we actually have on our books for that asset. We're going to do the same process with our equipment. So our equipment initially cost us $95,000, but again, we've used that piece of equipment in order for us to help run and operate our business. So at this point in time, we think that our equipment is really worth $25,000 less than what we had originally purchased it for. So the book value then of that asset would be our $70,000. So we're going to total up those three items to get our total property, plant, and equipment as of the end of this period. And in total, we have $237,500 in property, plant, and equipment.